In this video, we're going to take a look at some of the safest high-yielding stocks and ETFs that are available on the market. The way I'll determine this is by looking at what stocks out there have the highest dividend coverage, which is how much money they have left over to pay distributions. In the case of ETFs, it'll be funds that invest in safer holdings, and everything we're going to look at today will yield a minimum of 8%. Be sure to do your own research to determine if these holdings align with your investing strategy, because some of them offer higher yields than others and some offer more growth than others. But with that being said, let's get right into it. The first stock we'll look at is MPLX. This company is a master limited partnership that owns and operates midstream energy infrastructure and logistic assets in the United States. They're involved in the gathering, processing, and transportation of natural gas. They're also involved in the gathering, storage, transportation, and distribution of crude oil and refined products. MPLX also provides services in the midstream sector across the hydrocarbon value chain throughout their logistics and gathering segments. They were incorporated in 2012 and they operate as a subsidiary of Marathon Petroleum Corporation. Before going further, I do have to warn that this stock does issue a K-1. A K-1 is a special tax form that you are required to file with your income taxes. If you use tax prep software like TurboTax or pay someone to do your taxes, you will have to pay more for that. So if you're considering an MLP like this one, it only makes sense to make a larger investment to make sure it's worth paying more for your taxes if you do pay someone to do that. MPLX is a company that's not only had some of the best dividend coverage, but also some of the best payout growth for a high-yielding company. Last week, the company surprised everyone when they announced they were increasing their distributions by 12.5% to a little over 95 cents a quarter. This was the company's biggest increase in their 12-year history, and you can see since their IPO, they've never had a dividend cut. As of last quarter, their distribution was more than 160% covered. That's some of the best distribution coverage for anything in the market yielding over 8%. As is the case with every investment though, there is some degree of risk involved. Some people are just regularly concerned about the decreasing demand for oil and the slowing output of it. The way I see things regarding their distributions, if they believe things were taking a bad downturn, they wouldn't have increased their distribution so aggressively. They would have chosen to be a little more conservative with their payout instead of increasing it by over 12%. But it seems obvious that the management team believes that things are going to be really steady going forward. For many years, MPLX has seen consistent growth in their earnings and cash available for distribution. Their compound annual growth rate of their distributable cash flow has been 7.7% per year since 2020. So I think it's pretty clear that MPLX is clearly in a really good position with their distributions. If you're okay with a K1, then a company with good coverage and a high yield with growth is pretty appealing in my opinion. The next holding we'll take a look at is the InfraCap Preferred Stock ETF, ticker PFFA. According to its website, the fund seeks current income and secondarily capital appreciation through a portfolio of preferred securities issued by companies with market capitalizations of over $100 million. If you're the kind of investor that likes a high yield that's steadier, then holding preferred stocks is a really great consideration. Owning preferred stocks still represents ownership in a company, but there's a couple distinct things that make them different from common stock. Preferred stock shareholders must be paid dividends before common shareholders. They also have a higher claim to assets in the event the company goes bankrupt. The downside is that, although they do offer higher yields, most preferred stock distributions are fixed. So if a common stock is known for increasing their dividends on a regular basis, the preferred shareholders won't benefit from that. Preferred stocks don't usually move much in share price because they usually trade near their par value. This is what can make them much sturdier investments because they're really more like bonds. What PFFA does is it takes these safer investments and pools them together to add diversification. It then applies a moderate amount of leverage to them in order to boost their dividend yield. Anytime you add leverage to something, it is going to increase the risks involved. But considering it's leveraging a much steadier class of investments, it's not as risky as it would be if they were leveraging other things. PFFA yields around 9% and it also pays monthly dividends, which is even better. Again, I would not anticipate a lot of growth coming from this holding, so it's likely better geared towards income investors. But still, a 9% monthly yield on safer assets is still pretty interesting to me. Up next, we'll take a look at Ares Capital, ticker ARCC. They're a BDC that's been my favorite in this sector for many years now. With a portfolio value of nearly $26 billion, this company continues to be really well diversified across asset classes and sectors. They're one of the oldest BDCs out there, and they continue to post better numbers than a lot of their competitors. They don't grow their dividends as often as others, but they've done really well in fortifying themselves. On October 30th, this company released their latest earnings, in which they did miss their earnings consensus, but they still post some really good numbers. Their dividend is currently about 121% covered, which is one of the highest in the industry that I could find. Their non-accruals, which is how many of their investments aren't earning interest, have gone down for 2 quarters in a row. Today they make up only 1.3% of their investments, well below their average of 2.8%. The BDC average right now is 3.8%, so they've been really successful at picking good investments, far better than average. Because their stock fell slightly from missing earnings, ARCC now offers a yield exceeding 9%. Compared to other companies, they haven't been as aggressive when it comes to growing their dividend or paying special dividends. But it's because they've been approaching things with a lot more caution. Some BDCs that have grown their dividends in our high interest rate environment are now having a more difficult time covering them, so I appreciate the caution that Rithm Capital has been employing. And again, their huge size attests to 2 things. First, they wouldn't have gotten so big if they were bad at picking investments. Second, their large size helps for diversification. Each investment they hold makes up a much smaller percentage of their overall portfolio compared to many other BDCs out there. Their management team made it through the financial crisis, and if there was another once-in-a-lifetime crisis, then Rithm is a company that I'd believe in. Of course, there could always be some kind of surprise corporate scandal in any of these companies, which would change things, but they've continued to perform very well. Another stock with really excellent dividend coverage is Rithm Capital, ticker RITM. I just talked about this company less than 2 weeks ago, so I won't go too in-depth here. They're an asset manager that focuses on real estate, credit, and financial services. They have a lot going on in what they do, and they're more than just your typical mortgage REIT. Most MREITs only invest in or they issue mortgages and mortgage-related securities, but Rithm's expanded into more areas than that. Over the years, they've acquired more companies to better prepare themselves for more economic environments. Today, they own a company that owns single-family rentals, a title insurance company, a property management company, a company that provides fix and flip loans, and 6 other businesses within the real estate realm. When it comes to their dividend coverage, they currently have what's likely the best coverage in their sector. According to their most recent earnings, Rithm's last dividend was 188% covered. That's pretty incredible in that I can't think of another stock currently out there that's offering both a 9% yield and coverage that good. The only concern I've had for this company, which might be more of a theory, is that someday they might switch away from being a mortgage REIT, considering they've said that they want to become one of the largest real estate companies out there. But they've never discussed reclassifying themselves away from being an MREIT. So right now, considering their high dividend coverage, they seem well prepared in the event of some kind of real estate crisis, not that that's being predicted. Again, just like most of what we've looked at today, their growth is definitely lackluster, so this is probably better for an income investor. But it's still comforting to know that their dividend is so well covered. And that's going to conclude our look at several investments that are currently offering some really outstanding dividend coverage or have safer holdings. A lot of these investments don't really offer a ton of dividend growth with the exception of MPLX. But holdings that offer yields of over 8% don't typically offer very aggressive growth in their distributions. But still, an 8 or a 9% plus yield is likely going to attract a lot of people who like to live off dividends. And plus, just thinking about those dividends being reinvested back into buying more shares is really going to create a huge snowball effect. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.